Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we're taking a closer look at investing in the ETF industry and its incredible rise over the past few years. To discuss this topic, we have Mike Venuto, CIO at Toroso Investments, to enlighten us on what is going on in the ETF biz and why more growth might be ahead for this space too. So if you have any questions or comments, make sure to send them in to podcast@zacks.com, and don't forget to find the Dutram Report on iTunes and give us a review there as well. But stay tuned for my chat with Mike right after this. Okay, Mike, thanks for joining us today. Now, Mike, I am obviously an ETF nerd here. I mean, come on, I've got a podcast on ETFs, but I think a lot of regular people out there don't really understand what is going on in the ETF industry and why it is one of the best growth stories in the world of finance. Perhaps you can start off by discussing some of the trends that are being observed in this market today.
I would consider myself an ETF nerd as well.
Oh, good.
So I think it's a nice club to be part of. Yeah, I mean, the trend is growth. And I think that growth is driven by being aligned with the client, right? The clients want lower cost solutions. They want transparent solutions. They want liquid solutions. And the ETF structure delivers that. So that's why over the last, call it decade, we've seen ETF growth average about 19% a year. And, if you look at the first 14 years of ETF existence, they got to $500 billion. The last $500 billion only took 6 months. So there is an acceleration in desire from the client base. And when you align with the client base, it's likely that you see growth.
So do you think investors can expect this trend to continue? I know a lot of people out there are talking about, quote, an ETF bubble, unquote. What are your thoughts on that?
So I don't think that the 19% a year is going to be that way in continued growth 10 years from now. It will stable off, right? But as of right now, mutual funds are still 4 times the amount of assets that are in ETFs. Today, ETFs on average own about 6.4% of every stock in the U.S. It's not a big number. Mutual funds are north of 20% of every stock. So there's a lot of growth to come. I think we can sustain this kind of 19-20% growth rate until maybe it's about a 50-50 mix between ETFs and mutual funds. The irony, and one of those, I guess only ETF nerds know, mutual funds are growing still too. They may be seeing some passive versus active issues and things like that, but the entire base of 40 Act product, whether it's mutual fund or ETFs, continue to grow. It's just ETFs are growing at a faster rate because they're more aligned with clients.
So what do you think the biggest hurdle is to further growth in the ETF world and, eventually taking over mutual fund assets at some point down the line?
Well, I think the current stagnation or potential stagnation is the race to zero. Vanguard has done something amazing for individuals and investors by making essentially beta almost zero. Burton Malkiel had an article out on this the other day, right? The world is now getting access to beta for essentially free. And iShares very intelligently came out with their core products and offered that as well. That said, that's going to hit its point and then be done. We'll have free beta. And then what we'll get is innovation. To me, the key to future ETF growth is all about innovation, right? ETFs democratized access to bonds, and then they democratized access to gold, and now they've democratized access to volatility, all the VIX products. And all of a sudden, we're starting to see democratized access to active management. And there's news out just yesterday of potentially, a more likely democratized access to Bitcoins. There's going to be democratized access to hedge fund strategies. It's innovation that will allow the growth. That is the key to the continued cannibalization of mutual fund assets.
And is there a reason we're not seeing the same sort of innovative trend in mutual funds, do you think?
I think we are. I think, everybody points to ETFs and say they have taken away just from mutual funds. The real person they've hurt is hedge funds. right? Hedge funds are the antithesis of ETFs. Hedge funds are expensive. Hedge funds are not liquid. Hedge funds are not transparent. Mutual funds are somewhere in the middle, right? They're pretty liquid. They're a lot cheaper than hedge funds, and they have some transparency. So what I have seen, last year, Deborah Fier put out the paper on ETFs surpassing hedge fund assets. And then I saw the Wall Street Journal the other day, Laura quoting that ETF assets are now $1 trillion more than hedge fund assets. So I've seen a migration of complicated hedge fund strategies into the mutual fund world, where they still need a little lack of transparency or a little lack of liquidity, and a migration of mutual fund ideas that don't require lack of liquidity or transparency to the ETF world. I do think that there are some things that in order to invest in them, the liquidity needs to be a little bit tighter. And there's some great rules, right? Another ETF nerd, Dave Noddick, is constantly telling us about the liquidity rules and looking at how everything's working. So the real cannibalization that's currently occurred is hedge fund ideas going to mutual funds first, and mutual fund ideas that don't need to be illiquid going to ETFs. So it's a long transition, but it's pretty amazing to see how this is benefiting the end investor.
Yeah, and I think that's a really good thing to point out. And man, I didn't know there were so many ETF nerds out there. But
I would say it's an elite club of about 10 to 15 people.
Yeah, so I wanted to switch gears and talk about an index that actually tracks this market, and it's now the basis for an ETF, the ETF Industry Exposure and Financial Services ETF, ticker TETF. So basically, it's an ETF for the ETF industry, if you will. And I gotta admit, when it first came out, I was a little skeptical that there were enough publicly traded companies involved in the ETF business to make it viable, but I was very wrong looking at the number of holdings in here in the index itself. So maybe first off, you can tell me a little bit about the strategy behind targeting this segment of the finance world. Is it based on the growth? And it seems like you've done a good job finding enough companies involved in the area. So maybe also talk about some of the index components and how you decide which are added and which are excluded.
Wow, that's a big question. So
Yeah.
I'm going to start by giving it context. I'm a big believer in knowing why something exists before explaining how it exists and what it does. And the reality is Toroso Investments, that's the firm that I started about 5 years ago, was created as an ETF research entity. And I did that after coming from the hedge fund world. And in that hedge fund world, I had invested alongside clients in my firm as a private equity investor directly into ETF companies. We saw them as a competitor to us as a hedge fund, and as a hedge, we invested in emerging global advisors. As a private equity investment, we were very involved with Wisdom Tree and a number of other startups and things like that. And my partner, Guillermo Trias, who is actually the person who had this idea, did something similar with some things at Global X. So about a year ago, he looked at me and he said, why can't other people invest like this? And I said, well, people don't think there's enough public companies, just like you said, Eric. And so we started to think about it and say, wait a minute, is it just the sponsors that are making money here, or is it the ecosystem? And so when we designed the index to capture that exposure, our whole goal with the index is how do we capture that 19% a year growth and migration to low-cost, transparent, liquid product? And we said, let's look at that ecosystem and segregate it. So you have the obvious play, the sponsors, right? The pure play Wisdom Tree or BlackRock, Invesco, which there's rumors now that Invesco is acquiring Guggenheim's business. So you've got the fourth largest issuer possibly acquiring the eighth largest issuer. So there is a lot of pure exposure to the sponsors out there that you could acquire. There's also a lot of much smaller ones that are coming every day. The second kind of group that I don't think people realize there was enough of them out there, but it's the index and data services. So S&P, MSCI, but also the Morningstars and the FactSets that are making all the data and concepts around this. The third group we looked at were the exchanges. And this is by far one that I think people really discount because they are so connected to the ETF industry. They are involved not only as the listing agents, but also a lot of data. Most of them also have indexing businesses. Like CBOE, for example, has the VIX, and the VIX is not popular in the world of mutual funds, but it's insanely popular and very lucrative for them in the world of ETFs and ETNs. So there's all those components. And also the exchanges get involved with things like XTF or ETF.com. So they've acquired that data as well. Then we have the liquidity providers. So we constantly hear about spreads and volume and all those things with the world of ETFs. And if there is a cost there, well, somebody's collecting that. And that's companies like Virtue, which just acquired KCG and now is one of the largest traders of ETFs. And then the final bucket in our ecosystem is the service providers, right? And I love this one because it's the example of how you capture Vanguard. So I know Vanguard's the second largest issuer, and you can't capture their expense ratio. I totally get that, and that is a criticism that I accept of the index. However, when we look through the Vanguard prospectuses, we've identified 13 other companies in our index that Vanguard clearly states they're working with, they're paying in some way. So whether it's State Street or Bank of New York or JP Morgan as a custodian or MSCI or S&P as a index provider or the exchanges or all of these various other entities. And that's how you capture the growth. I don't know if you even want to capture the Vanguard expense ratio. It's not very big, but capturing all the other revenue being generated by their growth is the key. So I know that was a long question with a long answer. Please help me make sure I answered all the right components.
I think you definitely did. And yeah, my fault for the long question there. But here's a nice short one for you. What about the weighting for these different areas? How do you decide which segments get the most weight and that sort of aspect?
So that is something that is innovative here, and it actually goes back to the question of why hasn't somebody done this already? And I think the answer is if you just go look for the companies and market cap weight them or equal weight them, you're not really going to capture the growth. What you need is what I like to think of as active research with passive implementation. So what we've done is kind of a two-step process. We quantitatively go out and find all the companies involved. And when we do that, we build a database tracking all these companies. We do a liquidity screen, leaving out the companies with less than $200 million market caps. And there's some interesting companies down there underneath there that I hope to be in the index someday. But first, we have to think through the investable nature of it. Now, that's the quantitative part. The qualitative part is we built a committee of ETF insiders, people who have been involved in either private equity or the due diligence of ETF managers and things like that. So on that committee, we have Linda Zhang, or Dr. Linda Zhang, who's one of the co-founders of Women in ETFs. She was a head portfolio manager at Windhaven, involved with Schwab, all of those components. We have Chris Monaco, who's the financier through ICE Ventures of multiple different rock star ETFs. We have Kevin Carter, who's a serial entrepreneur, currently involved with EMQQ, but also many different startups in the world of specialty finance and things like that. We have Burton Malkiel, kind of the father of the idea of indexing. It's his book that really helped Bogle make the decisions to move towards indexing. And now finally, Scott Martin, who's one of the former PMs of Astor and CIO of Kingsview Asset Management. So essentially, that group of people sits down and thinks through these companies. And now we go from quantitative to qualitative back to quantitative. When we look at these companies, we discern and research and discuss which ones are purest to the exposure. So the ones that are purest, they go into what we call Tier A. And Tier A is 50% of the index, and we equal weight the Tier A names. So the Tier A names are things like WisdomTree and BlackRock and Invesco and Charles Schwab those are the things at the top of the index grabbing the true exposure. The second tier are the companies that are they're meaningful, but it may not be as meaningful to the balance sheet. So it may not be coming through to the end investor, that growth. So that would be a company like JP Morgan. Yes, they're making a big difference in the world of ETFs, but on the balance sheet of JP Morgan, it's not a huge piece of the revenue yet. Tier C is 15% equally weighted, and those are companies that are but not fully committed yet. And, they're growing through the process. You get a lot more of the service providers and things like that in that tier, and they're really there because they're going to be part of it, but we don't want to miss that exposure. So those are companies like Virtus or Northern Trust, Ameriprise, which just acquired through their Columbia Threadneedle, acquired Emerging Global Advisors. And we think they will be meaningful, but they're not meaningful enough yet to be a full big weight in the portfolio. And then finally, Tier D is the 10%. These are all companies that have just gotten in or really making a unique bet into this space, like a Legg Mason. Just got in. We hope they will be a Tier A someday, but it's not a pure play yet. My favorite example of this, though, is 5 years ago, Charles Schwab was barely in the ETF world. Today, they're the number 5 issuer, and nobody's even close to beating them. The way we've constructed this index is for a company like Charles Schwab to have been in like a Tier D 5 years ago and slowly graduate them up as they get the purer and purer exposure to the growth of the industry. So it is a combination of qualitative data with quantitative interpretation by industry insiders and then implemented in a tiered passive approach.
Now, that's interesting because I think some people might argue for companies like a Charles Schwab or even a State Street or BlackRock, they have so many other businesses that are, just as important, if not more important to their actual bottom line, that their success isn't directly tied to what happens in their ETF side. What would you say to someone like that?
So, number one, I think that if you think of State Street, people first think of the Spiders or GLD and things like that. And yes, they're meaningful at State Street, but it's hard to argue that's what's driving this giant financial institution. What people forget, though, is how else State Street's involved. Right? State Street uses ETFs to manage money for institutions. State Street is the main custodian for more than half the ETF market. So it's not just about them being a pure play as a sponsor. It's them being a pure play in terms of correlation to the growth of assets in ETFs.
And I also wanted to ask a little bit more about the index providers such as MSCI or S&P. How important would you say ETFs are to their business?
So I would say ETFs completely changed their business. And Dave Blitzer really kind of showed that in 2006. So one of those little-known secrets in the world of indexing is that the S&P that we look at today is quite different than the S&P prior to 2006. Right? So most indexation up until 2006 was done on market cap weighting. In 2006, most indexing switched to float-adjusted weighting. And the reason is index companies realized that they were no longer just a research provider. They were no longer a data source for benchmarks. They were now in the game of asset management. They were now in the game of basis points. And if you can only charge 1 or 2 basis points, well, you've got to have a massive liquidity and a massive amount of capacity. And that's that move to float-adjusted weighting. Now, there's some good and some bad there, right? Like, I think it's done an amazing thing to change their business models to recurring revenue and things like that. I do think it has, in some cases, created less intelligent indexes. So, for example, it contradicts the idea of insider ownership, right? So Walmart should be, a top 10 position in the S&P. But because the Walton family owns so much stock, I believe it's like number 22 or 23 in the index in terms of weight. So if on average ETFs own 6.4% of every U.S. stock, when you look at Walmart, it's only 2.25%. So this move towards being in the world of asset management has definitely helped them grow and create more recurring revenue streams. The index providers have the best net margins of any other companies in our index. But at the same time, that move has actually changed the world of investing to a certain degree. We now have this counterintuitive approach, whereas when insiders are buying or are big parts of the company's shareholder base, they're actually underweighted in indexes. And the exact opposite happens when they're selling. When they're selling, the indexes and ETFs are who are buying. It kind of goes back to something you said earlier. Is there an ETF bubble? I don't believe ETFs are causing a bubble in the broad-based markets, but I do believe they are causing bubbles in certain small subsectors where there may be a lot of insider selling or a lot of desire to invest passively. REITs, for example. REITs, on average, are about 15% owned by ETFs, whereas the rest of the market's about 6%. That is a potential bubble caused by ETFs.
Definitely. That's a good point to note, that the exposure is going to be, it can be quite different depending on the segment. One last question I want to ask you, though, because we are kind of running up against the time limit. So how might a product focused on the ETF industry fit into an investor's portfolio? Is this to be thought of as a replacement for broad finance exposure that you might get with something like XLF or VFH? Or how do you see this sort of focus on the ETF industry fitting in?
So I kind of see two ways to look at it. Number one, it's only got about a 20% overlap to XLF, or the broad-based financials. So it is a way to acquire the companies that are growing in the financial industry. Since the index came out, we're up about 10%, and the financials industry as a whole is up about 5 or 6%. So it has been working to capture that spread of growth. The second kind of way it could be used is just as a global growth theme. If you believe the world is going to continue to embrace low cost, transparency, liquidity, and request that their assets be managed that way, well, this is a way to capture that exposure.
Definitely. All right. Well, thanks for taking a look at the ETF industry with us, Mike. Great to have you on.
Thank you, Eric. We should get nerd badges.
Yeah,
I'm gonna get one for you. ETF nerds.
Great. I'm looking forward to it.
Have a great day.
All right, everyone. That was Mike Venuto, CIO at Toroso Investments. The index we discussed was the Toroso ETF Industry Index, and it is the basis for the TETF fund. Well, hope you enjoyed this edition of the Duchem Report. Make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go on over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. And don't forget to find and review the Duchem Report on iTunes. And if there are any topics you want us to discuss, feel free to reach out at podcast@Zacks.com, my Twitter page @EricDutrem, or leave us a comment on Facebook too. And be on the lookout for a new edition of the Duchem Report each and every Thursday. But until then, for Zacks.com, I'm Eric Dutrem.